Hey guys, this is an update on a SOFI play I made a couple weeks ago. So to recap from my previous video, I had sold a 13.5 strike expiring today, January 24th. SOFI has been running, as you can see in the chart, pretty strong. So with the put value down to a cent, I took advantage of yesterday's early morning dip to roll the put out 2 weeks to February 7th. Same strike of 13.5, and the point was just to capture more premium. So with earnings on Monday, the 27th, premiums are always going to be a little bit juiced around that time. Okay. So for me, the play is a win-win, and what I mean by that is if the stock drops below 13.5, then I get my shares back at the same price they were called away last year. If the stock stays flat, around 18, 17, then I can continue to sell puts around the same strike for a decent premium. If the stock jumps, which I would not be too surprised about, but if the stock jumps to where it's no longer attractive to sell puts at the 13.5 strikes, if the stock goes up to even 20, 21, then those 13.5 premiums are going to dry up pretty quick. So if that were to be the case, then it just means that of course I keep my premium, and my uncovered shares will do great. So again, I am long the stock. I do have shares that I do not sell options on. So again, if the stock were to go to 20, 21, even 22, then my existing shares will reap the benefits of all those gains. So as a basic principle, if I am selling calls on a stock I own, I never sell calls on the entire lot. I'll always leave some uncovered, just in case the stock really rockets up, as has been the case with SOFI. Started at 14 and now is up to 18 and could go, of course, even higher next week. So that wraps it up. I'll maybe do an update in a week after the earnings moves settle.